Good evening, everyone. I'm Romario Sterling. Thank you so much for joining us for our virtual investor briefing. Kingston Properties Limited additional public offering went live on Tuesday, April 19. And today we wanted to give you an opportunity to learn more about the company and their growth trajectory. We will start with opening remarks from our CEO of VM Wealth Management, Rez Burchinson, before moving on to a presentation from CEO of KPREIT, Kevin Richards. We will then go directly to your questions. At that time, please raise your hands to be selected to ask your questions. You may also share your questions and comments in the chat. Thank you again for joining us this evening. We plan to have an engaging conversation. So without further ado, I will now turn to Mr. Rez Burchinson for his opening remarks.
Good evening, everyone, and welcome to VM Wealth Management Investor Briefing on the Kingston Properties APO. Very excited for us to have this session this afternoon, and I'm quite sure that the persons who are watching on the various platforms will certainly, at the end of this session, be more informed regarding making an investment in the KP APO. As you know, VM Wealth is committed to providing our shareholders, clients, and potential clients with information that will empower them to make sound financial decisions towards achieving their financial goals. And this is why we host these briefings, and this is why we invest so heavily in digital technology. VM Wealth Management is certainly very proud to be the lead arranger and broker for this transaction, particularly because of our appetite and a bullish outlook for Jamaican real estate. We've been a major player in the real estate market over the years, evident by our position as one of the largest shareholders in Kingston Properties. So we're actually declaring our interest. Furthermore, we have shown support for this company via debt raises and the last APO that was done by Kingston Properties. And we're very pleased with the outcome of our support. I mean, Kevin, when he comes to the podium, will share with you the history of performance of KP and will clearly articulate the trajectory of growth, as mentioned by Romario, towards ensuring that investors are more informed regarding the outlook for KP and towards ensuring that they certainly make an investment. The capital that we have provided to KP over the years would have certainly contributed to an expansion of their portfolio, both locally and internationally. And we've also seen a material increase in the performance drivers and the performance metrics that are tracked by the local investment community. Just want to highlight again that one of the reasons why we're pleased is because we believe that the local investment market is turbulent. We're seeing rising interest rates and we're seeing rising rates of inflation. So the question is, what are the asset classes that will protect investors from an inflation surge? What is that inflation hedge? And I may dare say that real estate is one such asset class. But you have a unique hybrid in KP by being a real estate investment also listed on the Jamaica Stock Exchange. So I certainly want to encourage persons throughout the session to listen carefully, to formulate their questions, to ensure that at the end of the session you're very informed going forward. I want to encourage everyone to ask your questions, to empower yourselves to what we say at VM, transform you every day. But I want to leave you with a quote from a gentleman called Napoleon Hill. Most of us who are investment professionals will know the book that he would have written, Think and Grow Rich. And he says, knowledge is only potential power. It becomes power only if and when it is organized into definite plans of action and directed towards a definite end. So it's not only important for us to be informed, but to act on that information towards achieving our financial objectives. Thank you very much. I'm going to hand to Kevin, who will take us through our presentation, and then at the end, Romar will come back up and take some questions. Thank you very much.
Thank you, Rez, and thank you, Romar, and thank you, everybody. Good evening. Thanks for taking time out of your busy schedules to join with us and to learn a little bit more about Kingston Properties and this amazing offer that we have for you today. Kingston Properties, let's start with who we are. Our philosophy is that we are the gateway to global real estate investing. Our simple motto, buy local, own global. This is our first APO, or additional public offering, and our fourth raise, first being our IPO back in 2008, and we've done 2 successful rights issues after that, the last one with the support of Victoria Mutual, and we're happy for them to be on board with us again for this year. So briefly about this offer, we're looking to raise approximately $1.5 billion. That's an additional 200 million shares at a price of $7.50, which, as we go through the presentation, we see what the value behind that price is and why we think that this is a great offer. As Romari mentioned earlier, we opened on April 19 and we close on May 10. We do have the option of upsizing the offer if the demand is greater than the 1.5 billion. That's by another 50% up to 2.25 billion. Again, VM Wealth is partnering with us not only as lead broker and arranger, but also as playing an underwriting role in the offer of about $500 million. The other advisors to the offer include Hart Murad Fata, who is the attorneys on the deal. KPMG has been our accounting partner for more than a decade and continue to be that way. And also our trustee and registrar agent, the Jamaica Central Securities Depository. We're happy for the support that we've also been getting from a number of other institutions, primarily brokers in the community who have joined as selling agents for the deal. They include JMB Investments, Scotia Investments, JN Fund Managers, Barita, and Sagicor Investments. So let's talk a little bit about what our strategic imperatives are going forward, as well as what we're going to be using the funds for. We talk a lot, if you've been following KP a lot, particularly over the last 2 years in the period of the pandemic, we've been using the word resilient a lot. And that speaks to the kind of business that we've had over the last 2 years, a fairly resilient one that has outperformed a lot of key metrics. And in terms of our financial performance, has been a lot better than a number of other companies listed on the stock exchange. And I think it speaks great testament to the stewardship of the company from the board level to management and to our entire staff and key stakeholders. So we want to maintain that strategy of resilience. And while we're maintaining resilience, we're growing the portfolio. So we're looking to grow our capital base as we had said we would do 3 years ago. We'll continue with our geographic dispersion of our portfolio because one way of managing risk is to diversify the portfolio into different subsectors, different geographies that we will continue to do with this raise. Having been in existence since 2008, May would make 14 years since this company has been around. We've weathered the storm, and over that time period, we've built some strategic partnerships, and we want to continue to leverage those relationships to expand the portfolio and to enter into new markets. Part of our growth is to achieve at least 1 million square feet of properties under ownership or management, certainly over the next 3 years. So what are we going to be using the funds for? Back in July 2021, we had a short-term, a 13-month bridge loan facility with VM for $700 million, which we plan to repay out of the proceeds of this raise. Also, from that $700 million, we acquired a number of properties, 2 of them that we plan to develop as part of our foray into greenfield developments. One of them is a property in New Kingston, which we're going to be constructing a multi-story, multi-use commercial building. And the other one is going to be developed for small warehouses in the Crossroads area. Additionally, we'll continue with our strategy, which is to seek out value-add opportunities in the real estate sector, as we have been doing certainly over the last 5 to 6 years, and that has reaped great rewards and dividends for us over that period. So let me talk a little bit about KP. I know we've been listed on the exchange for 14 years, but I'm hoping to make KP a household name in Jamaica. So it is for persons to understand that as a REIT, what we do is we democratize the ownership of real estate assets. That's exactly what a REIT does. But you have to understand that there are many persons who play in the real estate investing space in Jamaica, and it's important that we establish our identity, what it is that KP does. How does KP differ from all the other entities that are out there on the market? We specialize primarily in value-add commercial properties, that is in the industrial space, office, multifamily, or multi-use. And I'll talk a little bit about what the value-add proposition is and how that strategy has worked exceedingly well for us over the last 5 to 6 years. In terms of our structure, we have 5 subsidiaries, 2 in Jamaica and 3 outside of Jamaica, 1 in the Cayman Islands, 1 in St. Lucia, and 1 in Miami. And that is how we expand our portfolio in regions outside of Jamaica. Our team is comprised of a number of notable persons in the area of finance, law, real estate, accounting, etc. And we have a very strong board that continues to offer great support to management in the development and growth of this company. As part of the management team, there's myself, Andre Francis, our CFO, is also here with us. Tatisha Rowe is our Senior Manager of Operations, and Roxanne Kelly, our Financial Controller. All persons who've been with the organization for a long time, which is also another testament to the kind of company that we have. We look at risk as a part of any business strategy and how we try and manage risk to ensure that the company stays strong. And this is a point that I'd like to make, is that it's important for us, particularly when we're in evolving markets, to constantly look at risk and evaluate our risk mitigation strategies and ensure that we continue to grow and to stay a solvent company. So let's talk a little bit about the different categories of real estate. And I did mention earlier about the value add strategy, which is what we have been using to grow our portfolio over the last 3 to 5 years. There are 3 main categories. There is the core category, and these are usually buildings that are, typically Class A buildings that are in very good locations, have very strong tenants. You're basically collecting rents. You don't need to do any sort of improvement to those properties. It's almost like a bond. At the other end of the spectrum, you have what we call the greenfield or development type properties. Those are where you have to be doing ground up. So you're building stuff out of the ground, or you're doing a massive conversion. Say you're converting, office building into residences or condos, for example. That would be considered as greenfield or opportunistic. And obviously, that carries a higher risk than the core category. We fit somewhat in the middle. Our strategy is the value add strategy. This is where you'd find a property. We try and identify a property that's in a very good location, probably could be managed better. Rents are below market. It's probably in a great location, so it is very marketable. People will want to be in that building. And we go in, we acquire the property, make the improvements, adjust the rents, and from the adjustment in the rent, you see the improvement in the value of the property. And there's a particular case study of a property that we acquired. And believe me, this is not the only one. I'm just highlighting one as a case study of a property that we acquired in 2018. And this is of the Grenada Crescent building, which is a property that's at 52 to 60 Grenada Crescent. We acquired that property in November 2018 for the equivalent of about $3.6 million US. Over that period, we've made some improvements, changed the tenant base, and during that period, next slide. During that period, we saw the appreciation in the value of that property by approximately 75% over a 3-year span. And the reason why we focus on this particular case study is there is always been this perception that the only way to get high returns from real estate is to do ground up or the greenfield or opportunistic type of real estate investment, as we highlighted before. But you can do that with a value add strategy, as we have done. And this is a particular case study that we're highlighting to show how it works. And the other reason why we like value add is because you are able to cash flow from day one. So unlike a greenfield project where you have to wait, 2 years or 3 years before you start generating any cash flows, with a value add property, you can actually generate cash flows from the day you close on that deal. And while you're making improvements, you're changing the tenants, you're adjusting the rents, and that's how you get that appreciation in the value of the property. Similar to how a private equity strategy works, where people identify a company that's probably poorly managed, go in, change, make some changes, and create value. That's how we create value, and hence the term value add strategy. Just a little bit about our portfolio. We're diverse geographically, as at the end of December 2021, we're 51% in Jamaica, 38% in the Cayman Islands, and 11% of our portfolio was in the US. When you break that down further, about 40% of our portfolio was in the industrial or warehouse space, 46% in office, 11% in residential, and a small 3% in the retail space in 1 or 2 properties, including that property that is pictured there on the lower left-hand corner, which is our flagship Cayman property, which is Tropic Center. We did our raise in November 2019, and coming out of that raise, where we raised $2 billion, we did a number of things. And if you think back to 2.5 years ago, this was just before the pandemic hit. So we went into 2020 with the ability to purchase very attractive properties, largely because we were in cash. And the thing is important about raising, the best time to actually do a raise or to make these types of acquisitions is during times of distress. We acquired an 88,000 square foot warehouse property in the industrial belt in Kingston, which we've done significant renovations to, and we've seen improvements in the rents in that property, and ultimately we will see in the improvement in the value of that property. The second one was an acquisition of a multi-story office building in the Cayman Islands. That's pictured right there on the left. It is a building called Harbor Center, which we acquired in July 2020. As you know, that was sort of like the peak of the pandemic. It was a fully tenanted and still remains a fully tenanted office building, and it is comprised of tenants in various sectors, and we'll talk about our tenant profile a little bit later. Also, over the last 2.5 years, we've acquired properties, as I mentioned, some of them that we plan to do some development on. And more importantly, we've entered into some important strategic partnerships. Those include the acquisition, which has helped us to make acquisitions or further deepen our presence in the US market, which is one of those markets that we still think is one of the most important markets in the world. We've entered into partnerships to acquire multifamily properties in the US, primarily in Atlanta, Georgia. And as well, we've entered into a partnership with a company that has a very strong presence in the commercial office space, building office space in Southeast Florida, primarily Class A office building, as well as a little bit of retail. Over that period, we've also been consolidating our portfolio and disposing of some of our condos. The condos formed a very great part of our strategy when we went into South Florida in 2010. But over that period, our strategy has shifted more towards more value-add opportunities outside of South Florida. So we've been disposing of those condos and deploying those funds into higher yielding assets in Jamaica and in the Cayman Islands. Since then as well, our stock price has increased by 60%. So for persons and we remember our reference point is November 2019 when we did our last fundraise, when we raised at a price of $562, and I'll go into a little bit more detail after that. And also, we've paid out about $1.3 million in dividends to our shareholders over that span. So some of the important investor considerations for this offer, I did mention about the stock price. Our stock price has grown by approximately 60% since that period of the rights issue, moving from $5.62 to $9. And when you compare that performance to the performance, say, of our benchmark, and the benchmark in this case is the JC main index, the index has declined or remained relatively flat over that period compared to how our stock price has performed. So we've outperformed the index. If you look at our stock price over the last 5 years, we had a stock split in May 2007. So when you adjust the price in 2016 for that stock split, it was the equivalent of $5. So you're comparing the stock moving from $5 to $9 at the end of December 2021. When we compare our performance to the overall market over that same period that we're talking about, so I remember if you had purchased in the last fundraise at a price of $5.62, how that stock would have performed, our stock performed over that period. You've seen that that same 60% compares favorably with the rest of the market, and I think that leaves us as sort of the 8th best performing stock over that period, and certainly the best performing stock involved in real estate investing over that 2-year period. So this offer at $7.50, and when you compare this offer price to a market price of $9, for example, you see that this offer price is a 27% discount to the last close price. It's a 57% discount to the 52-week high relative to what we think is the enterprise value of the stock. It represents a 64% decrease. And I know a number of brokerage houses have already put out their research paper and have given their fair value of the stock. Again, $7.50 remains a big discount relative to what is considered generally as a fair value of the stock. We've spoken about dividends because, again, we have adopted the tenets of a REIT, which means, we focus a lot on dividends. So one of the things we did was to change our dividend policy to pay out up to 90% of our funds from operations as dividend to our shareholders. So a part of our strategy is to continue to grow our funds from operation, which really is the amount of cash that we generate in the business. So once we continue to generate a lot of cash, then we'll be able to pay out a lot more in dividends. And in terms of what our dividend track record has looked like over the last few years, last year was a historic year for us. We paid out more than twice the amount of dividend that we paid out in the prior year, and this is largely because of the growth in our funds from operation during 2021. We've done some comparisons with some of the other real estate companies, or I should say VM has done that. Let me make it very clear. And they've done some comparisons, and that is information that they can share and continue to update. But essentially, in terms of an overall performance of KP stock, both in the appreciation of the price of the stock as well as the dividends that we've paid out over the period, we still outperform some of the other companies that are involved in the real estate investing space listed on the Jamaica Stock Exchange. So let's talk a little bit about our financial performance, and I'll run through what we've done over the last 5 years. Group rental income has doubled over the last 5 years, moving from 1.5 million US to just under 3 million as at the end of December 2021. And again, I'm going to be speaking, all of our financials are in US dollars. We are a US dollar company because we generate more than 90% of our earnings in hard currency, whether it is US dollars or Caymanian dollars. So every reference here is in US dollars. Our net operating income has also grown from $560,000 in 2017 to just under 1.7 million US at the end of 2021. And that's an important metric because we continue to monitor our net operating income margin. That really speaks to how efficiently we have been deploying the funds that we've raised over the years, whether it was equity funding or debt funding, or funds generated within our operations, how we've deployed those funds into new assets. So for every addition to our portfolio, clearly we've been doing it fairly efficiently, and that's demonstrated by the net operating income margin, moving from 48% in 2020 to 57% in 2021. We've been fairly judicious with our use of debt. So total debt represents 34% of our total assets as at the end of December 2021. 40% of our total investment portfolio, and 53% of our total equity. When we look at our 5-year performance in terms of CAGR, 14% growth per annum on average for the last 5 years in terms of our rental income, and 25%, again, all in US dollars, in terms of our net operating income. We did talk about funds from operation, and again, one of the reasons why 2021 was a historic year for dividends is that our funds from operation grew from 621,000 in 2020 to 1.36 million US dollars in 2021. Just some quick highlights. In terms of our total revenue, this chart shows a composition of what is the composition of our total revenue. That's both rental revenue, fair value, and as well as other income, which includes fee income or dividends. Once you continue to see rental revenue grow significantly, again, this is cash that we're generating the business, which ultimately will lead to higher funds from operation, which ultimately leads to higher dividends. Of course, higher profits, higher revenues at the efficient pace at which we've been deploying those funds will also mean higher profits, and we've seen that come out in the financials, because over last year, we saw a 40% increase in rental revenue and a 65% increase in our net operating income, or that's demonstrated as a result of operating income before other charges. Our operating profits dropped by almost 150% from 1.4 million to 3.5 million US. Net profit grew almost 400% to just under just about 3 million US dollars in 2021. Our finance costs fell, and in terms of our average cost of borrowing in 2021, our US dollar borrowing was approximately 3.8% or just under 4%, and our Jamaican dollar borrowing, just one facility, at 6.4%. In terms of our return on weighted average equity, we finished at around 9.6% in 2021. Again, quickly, our total assets grew by 11% to 50.5 million, and our investment portfolio represented about $47 million in 2021. Total equity grew by 7% to 32.6 million, and loans, again, grew by 26% to 17.2 million. And I did mention that we're still fairly under leveraged. We still have greater capacity to increase our leverage to expand the portfolio. How the portfolio has grown over the last 10 years. In 2012, we ended the year at about 9.4 million US dollars as the size of the portfolio, and ended 2021 at approximately 47 million US dollars. You can also see the shift in strategy in terms of geography. Back in 2016, 70% of our portfolio was concentrated in condos in Southeast Florida, and that, having switched from that strategy and moved into more investments in Jamaica and in the Cayman Islands, you can see where that spread is now compared to where we were 3 years ago, 5 years ago. Kingston Properties, when we started, we adopted the tenets of a REIT. As I've often said, that there isn't REIT legislation in Jamaica. I mean, we have been lobbying for years through various administrations, and we'll continue to lobby. It's an easy fix. I can speak to me. So what we've been doing is to model our business off REITs and how REITs operate. What we've been doing is that we measure ourselves against a composite of US REITs just to see how well we perform compared to them. Again, because we want to build a world-class organization, so we adopt what we think are best practices for any operating company, whether you're a REIT or not. So what we do is we compare how we measure up against this composite of REITs, and this is something that is monitored periodically at the board level. We compare ourselves on various key ratios: debt to equity, debt to EBITDA, equity to asset, investment interest coverage, operating margin, net interest margin, return on average equity, price in relation to funds from operations, price to book value per share, price to earnings to ratio, dividend payout ratio, and current dividend yield. And in that, we've realized that our performance has been either favorable or in line with most US REITs. And I think that is a true testament, again, to the stewardship of this company and the kind of focus that we place on performance and meeting key metrics. I want to go back to that slide again because there are a couple of things that key particular metrics that I like to focus on. One of them has to do with the price to book value per share. There's always been some conversation that, real estate investing companies should trade at book value or discounted book value, when that's not been the case for most REITs that we follow. Those REITs tend to trade at either premium or multiples of book value. When you compare our year-end price of $9, KP was trading at a 20% premium to book value. That compares to the composite of 2.8 times. So in our estimation, if you were going to use a measure of US REITs, KP has been trading well below its value. The other metric that I like to look at is a dividend yield. Having paid out $900,000 in dividends last year, our dividend yield based on a stock price of $9 was equivalent of 2.3%. When we compare it to the composite, that was 3%. Outside of the 5% margin that we have, but if you use a $7.50 share price, then that dividend yield is approximately 2.7%. So that would make us in line with what that same composite. So briefly about our portfolio. Again, as I mentioned, we are in 3 main jurisdictions in the US, Cayman Islands, and in Jamaica. And in terms of our tenant profile, which is one of the things that has helped us to remain resilient certainly over the last 2 years, it's a function of our tenant base. 26% of our rental revenue is derived from tenants who provide financial services, 19% from those who provide government services, and manufacturing and distribution round out for a combination of about 19%. So the bulk of our tenants are either in financial services, government tenants, or in the manufacturing and distribution space. In terms of our top 10 tenants, 56% of our rental revenue is derived from our top 10 tenants, and most of them are in Jamaica and in the Cayman Islands, and in those specific fields, as we mentioned before. In terms of our investment yields, on average, our net income yield, net cash yield, this is net rents that we collect on top of the value of the property. When we compare it to what the acquisition cost was that specific property, it's about 10%. Again, this is all in US dollars. When you look at it compared to the current market value, because it now accounts for the appreciation and value of the property, it's roughly about just under 8%, 7.9%, as the average yield on a portfolio. Again, US dollar. As at the end of December, our average occupancy was almost 100%. We, again, using the value add strategy in one of our properties, that's the East Ashenheim Road property. At the end of December, that property was being partially renovated, and as at February 1, that property is now fully tenanted, so we are 100% occupied in all of our properties in all jurisdictions. Collections also, even during the period of the pandemic, has been far better than we anticipated. Particularly in the Cayman Islands, collections have been very strong, even during periods, because Cayman went through an extended period of lockdown, and tenants were able to pay, and we had very little difficulty in those markets. So what's next for KP? Again, I've been using the word resilient. We've been using that word resilient over and over for the last 2 years. We're going to try and continue to build a resilient strategy. And we're going to be growing the portfolio, growing all the assets that we manage and own. We've been kind of studying what's been happening in the real estate space, because what we want to continue to do is to future-proof the business. So we try and stay ahead of the game and look at where are the trends that are developing. There's a lot of demand for industrial properties, for warehouses, for data centers, self-storage, all of those things. And we want to be a big player in that space. So we've also been looking at what's happening with office. There's all this great concern about the future of office and whether, offices are going to go, people are going to be giving up space and there's going to be empty offices. We've not seen that happen over the last 2 years. And in some instances, we've had tenants who have requested for more space over the last 2 years. What we've been noticing with office is that people are more concerned about, sustainable practice, and which is why we're certainly looking at how we build or configure any of our spaces to make them sustainable, as it's very important we take great consideration for the environment. There's an increase in demand for what we call flex space, which is could be a combination of office, warehouse, or storefront, and that's particularly why we're going to be building those mini warehouses in short order. Multifamily is another space that we've noticed has been growing significantly, and this is largely because of the shifting migration patterns in the US, where lots more persons are moving into what we call the low-cost states, and we've seen quite a bit of demand for housing, and that's reflected in rent in specific markets growing significantly year on year in those markets. What's also been happening is that a lot of jobs have been moving into some of these low-cost states, so that continues to drive demand for space, and that's an area that we'll continue to be in. Next slide. So what are we going to be doing? As I said, we're going to be playing a greater part in the industrial and multi-purpose space. We're going to be building warehouses for the specific needs that I've identified. We're going to be looking at acquisition of companies as a strategy to enter into new markets and as part of our overall growth strategy. And we'll continue to dispose of our US condos and deploy those funds into multifamily properties across specific states in the US. So in a nutshell, what does KP offer? We offer you ownership in a diversified portfolio with strong real estate assets. Those assets, and when we talk about diversification, we're diversified across different geographies, into different subclasses, and with a wide pool of strong tenants. We give above average dividend payout when we compare ourselves to other persons in the space. Given that we've been in existence since 2008, and if you recall, 2008 was the year of the Great Recession, we were formed out of adversity, so we know how to manage during those periods. We have 14 years of track record for persons to look at how we've performed as a company and to evaluate our strategy to guide you in terms of how we're going to be performing going forward. Because we've used the value add strategy, we anticipate that there'll be further growth in the value of our properties. So we'll continue to see capital appreciation in the value of the properties, which will lead to higher equity, higher profits, and ultimately higher dividends, and hopefully, as we expect, a higher share price. Again, I will reiterate, we are a US dollar business. 90% of our earnings is in US dollars, and we pay dividends in US dollars as well. So I am available for any questions, and I'll hand back to Romario.
All right. Thank you for that presentation, Kevin. It was very comprehensive, and I think some of the key takeaways from that presentation is the fact that KPREIT has delivered on all fronts as it relates to the key metrics that you would consider as an investor before you make an investment in a company like this. One, stock price performance, they've delivered as it relates to that. They've provided income in the form of dividends, and the underlying assets have appreciated in value over time. And as I said before, those are key things that as an investor, you should consider before you make a decision to invest in this offer. And they've done that through the efficient utilization of capital, and we expect them to continue doing that with the successful raise from this APO. So without further ado, I'll go into the questions. So I'll start with the first question to our very own CEO, Mr. Rez Burchinson. And what I want to get from Rez is, why is VM so bullish on the real estate sector? And this is evident based on just the support that we've provided to KPREIT in the form of financing, as well as our very own investment in KPREIT as a major shareholder, and also our own property fund, which was the #1 performing fund in 2021.
All right, thanks, Amara. That's a very good question. So I wouldn't say that we're bullish on the real estate sector per se, right? I think our job is to try and find value and to extract that value. What we've seen certainly is that equities would be doing very well. And certainly there's also a space for real estate in any portfolio. So I know that a number of persons who are looking toward investment opportunities are looking to let's say the junior market, and then our responsibility to say, potential investor, you have to think broader than that. You have to think equities, main market, where there's lots of value, junior market, where there's growth, but also real estate. What we have seen in the real estate space, certainly on the residential side, lots of upside, right? But my view is that on the commercial side, there's lots of value. Kevin will tell you that when you compare rental rates in Jamaica versus Cayman versus other jurisdictions, we are materially below market. And what we're seeing is certainly that our economic numbers are changing for the better, right? Certainly before the pandemic, Jamaica was on a really solid growth trajectory, and we believe it's going to come back. So we believe that there's value in real estate, and we're simply saying to investors, look at this space. And the beauty about a KP is that, and Kevin made the point, he made the point about democratizing real estate. We all drive around Kingston and we see these fabulous commercial properties and we say, well, how do I participate? And we drive on because we don't recognize that we say that opportunity is closed off to us. But truth be told, that any investor can participate in a KP that has some really marquee properties in Kingston, in Cayman, and other jurisdictions. So we're saying to investors, look. You need to take a look at this opportunity. Kevin spoke to some really good metrics. US dollar holdings or rental income, fully tenanted, great location, geographic diversification. He's ticking all the boxes that certainly any real estate investor would want to tick. So we're saying, our responsibility is to clearly highlight that value proposition for all stakeholders.
Thank you for that, Rez. A very profound statement. And one of the things that I like that you mentioned is the fact that a vehicle like this gives the average Jamaican access to real estate. Otherwise, they wouldn't be able to invest in real estate directly. And I think, us doing this offer is in alignment with our mantra of being a mutually inclusive organization, giving access to all Jamaicans, creating opportunities, including investing in real estate. So I'll go over to Kevin now to ask him a question. So there's a topical conversation by people in the investment community, right? And they ask the question, why an APO as opposed to a rights issue? And the reason why they ask is because they believe that the APO dilutes existing shareholders as well as dilutes the EPS, whereas the rights issue kind of protects the holdings of existing shareholders. Could you just elaborate as to why you chose to go the APO route as opposed to another rights issue?
All right, that's a lot in there. Well, first thing, as I mentioned early in the presentation, this is our fourth raise. First was our IPO, 2 raises after that, and now this is our 4th one with this APO. What we found coming out of that is that after all of those issues, the number of shareholders we had, approximately 500 shareholders. That goes contrary to what our purpose is, as I've been repeating. We're democratizing the ownership of real estate assets. This is a great vehicle for persons, particularly small investors, to buy shares and own a piece of a marquee real estate building. That's how you participate in it. That goes contrary if, after all of these raises, you could only have 500 shareholders. We want to ensure that we have far more persons participating in, and we've seen the financial performance of this company and how the stock price has done well. We want more people to participate in it. So it was a no-brainer that the rights issue didn't achieve that. We also had a stock split in 2017 that didn't achieve that. The APO, and I don't know if I can say it, but certainly from early signs, we're seeing where this is moving in the direction to help that particular strategy. Now, there's also been a lot of noise also on the interwebs about this whole issue of dilution, and I think it's very important that we understand specifically what dilution is, or for persons to say exactly what do they mean by dilution, because you could be diluting your share of ownership in the company, or you're diluting the value. And you also mentioned in your question about the dilution of the EPS. And let me tackle that one first. If we are doing a raise, we're not raising these funds to go buy a yacht or to go party. We're investing those funds. This presentation showed you how we have deployed the funds that we've raised over the last 14 years and how that has added value and created value for shareholders. That has also I've showed how the stock price has performed over that period as well. So in terms of raising money, we're going to be generating more profits, which means the EPS, whether you add more shares, if you're generating more profits, then you're basically nil-nil, because we're going to be generating profits from that. We've seen that. We continue to use that strategy. We're not going to stay flat. Dilution of EPS only applies if you're increasing the number of shares and your profit stays flat. So let's understand that's exactly it. Am I right?
Yeah, man, you're definitely correct, definitely. Very good answer, so.
No, let me continue, because there's also another debate about the dilution of ownership. And the truth is, most minority shareholders, Rez, are you concerned about the dilution that you will get from this, or will you get any dilution out of this?
Okay, I'm concerned about, I'm confident that the growth in the EPS will continue, the ROE will continue, so I don't problem being diluted. Dilution isn't that thing for me anyway.
And that is from a shareholder who has more than 50% of the company. So a person with 0.000001% of the company should not be concerned in what share of the company they'll own. Take it a little further. Let's say we went the route of a rights issue, which we've done in the past. Persons who did not participate in the rights issue were diluted. So the point is, you're diluted whether you have an APO or if you have a rights issue. Tell you another way how you get diluted. If you sell some of the shares that you already have. So instead of selling shares, you should be buying shares if you're concerned about dilution. Am I correct?
Definitely.
I also showed a chart which showed how the company has performed over the last 2.5 years. Let's say the 2-year span since we did our last fundraise. It grew by 60%. If you remember that chart, the best performing company on that chart was a company that has negative equity and zero operating income. That was the best performing, by far, of all the stocks over the last 2 years. There needs to be a larger question asked. Why is that the case, whereas there are other companies that have, whether they've done an APO or not, some of them have done APOs. Why is it that they put out great results, but yet their share price languishes? There needs to be a greater conversation about what is actually driving, or who is actually driving share prices in this company. What I can confidently say is that what has happened in KP's case, once we continue to generate revenues, continue to generate profits, we will see the reward coming in the improvement in the stock price, and this is likely to happen again after we close this offer. I can tell you for sure that the stock market has a lot of problems, 99 of them if you want to say, but an APO is not one.
All right, that was very good, Kevin. And I definitely agree as it relates to the value proposition from the APO being access to more capital, which puts the company in a better position to continue its growth trajectory, expand the portfolio, and deliver returns to investors. So with that said, I'll take some questions from the public. So I see one question coming from Dwayne. According to the prospectus, part of the proceeds will be used to liquidate facilities that were acquired last year. Is there a timeline on this?
Of course there is. Why would we keep debt if we've raised equity?
And I want to know a timeline.
As we raise the equity.
Yeah, so it would be once we complete the raise successfully then and we get the proceeds, we'll be able to liquidate the debt. Can you elaborate on the change in the group's dividend policy?
Sure. We tied our dividend policy to the generation of cash because you're paying out cash, so it must be based on the generation of cash. So we've tied it to what we call funds from operation. And if you go through the prospectus, we outline how you calculate funds from operation. So if we're generating more cash in the operations, then we're able to pay out more dividends.
Hopefully that answered the person's question.
Well, I'll go on a little further.
Sorry
About Romaria, because the thing about it is the previous policy said out of total comprehensive income, which would include fair value. Mm-hmm. That's not a cash generating item. So if we were to pay out, let's say we generated 50% of our earnings as fair value. Mm-hmm. Then it means we're going to be paying against a non-cash item. And how do you fund that? You're either going to be borrowing or selling an asset to pay that. That is not a good strategy for a company going forward.
Understood. And for the members of the public, funds from operations is a key metric that is used to assess the performance of real estate investment companies. It looks at the core cash flow generated by the business by excluding one-off gains and losses and revaluation gains on investment property. Hence why Kevin said it best to assess the company's dividend policy against the core cash being generated by the business. Another question that I see coming in is Kingston Properties Limited underwent a strategic restructuring earlier this year. Can you speak to the benefits of that?
It was a simple strategy. Most of the properties that we own in the Cayman Islands, we were holding them through a St. Lucia vehicle. And essentially what we did is we created a Cayman company to hold those assets. That's it in a nutshell.
Any other questions coming in from the public? So Noel Da Costa, how would your portfolio weather a category 4 to 5 hurricane this year?
And that's a very good question. And that's one of the reasons why we've been looking at diversifying our holdings outside of the hurricane belt and why we've gone into Atlanta and we're looking at other states in the US. One of the things that concerns us, obviously, as a company is climate change and the impact of it, so things like hurricanes or stronger storms. What we have, and this is why we primarily focus on commercial properties, because unlike residential properties, those are affected to a great extent if there's a hurricane. Particularly in Cayman's building code was, I think, changed in 1998, and most of the buildings have been built to a standard to withstand storms, wind force. The issue that I think Cayman went through was in terms of, in Ivan in 2004, was flooding. So what has been happening in terms of the building code is that there is a requirement for buildings to be built at least 8 feet above sea level. So that is one of the key metrics that we look at when we're acquiring a property in Cayman, for example. Does it meet that particular metric? In terms of Jamaica, again, most of our properties are in the commercial space. So, and we've ensured that in terms of the renovations that we do to any of the properties, that we make sure that they are to code, but also from an insurance standpoint, we are insured at full replacement cost for the properties. There's some people who insure at some market value or some self-insure, but we insure at the full replacement cost for the vehicles of the property. So in case there's a natural disaster, then we have insurance to claim on. And we also have loss of income as well as part of the policy.
Okay, understood. Very good risk management strategy. I see another question coming from Joan McLeod. So her question says, for these new buildings, are you planning to plug into the sun? Also, water harvesting for these buildings, this would lead to higher profit, hence greater dividends.
Yes and yes.
Okay, good. And that ESG is an important consideration for investors these days. If you see some companies, they usually have a ESG report. So maybe in the future, we'll be seeing some ESG reports from KPREIT as well.
Check our next annual report.
Excellent. Any other questions from the public?
Yes. Coming in from Zoom, Stephen's iPad.
So while that comes up, Romario, I'll continue on the point about the building sustainably. We are looking at green certification for a number of our buildings by 2024. So that obviously means that we are going to be looking at things like using of alternative sources of power. Rainwater harvesting is a big thing. We're about to get into a number of projects, right, Henry? A number of projects at some of our properties for rainwater harvesting. But they're very simple things. For example, coming out of the pandemic, there's greater concern for the flow of fresh air through buildings. So we've spent quite a bit of funds changing out the air conditioning system at our Grenada Crescent building, for example, as one of our strategy in terms of building more sustainable and healthy buildings.
All right, thank you, Kevin. Stephen's iPad. Yeah.
Go ahead,
Go ahead,
Stephen.
Stephen. Can you go ahead with your question, please?
Right. Good night, everybody. Just a quick question. Clarity. Could you give an estimate as to the cost of construction for the greenfield projects, especially the very cool black building that you're planning for Cayman and any other ones in Jamaica?
Thank you, Stephen's iPad. In Cayman, the Gumtree building, I think that's the one you're talking about, that's estimated to cost about $3 million US dollars, 3.1 to be exact. That's expected to be completed by December of this year, and we're on the way for that. In terms of the two projects in Jamaica, one's estimated at around the equivalent of $8 million US dollars, and the other one at roughly about $5 million US dollars.
Hopefully that answers the question, Stephen. Any other? You want more clarity?
I just want to know about the return on investment for those buildings in particular. I know that generally you have a group carry for your return on investment, but what about like those properties?
Yeah, for properties in Jamaica, we usually target a double-digit return on US dollars for those investments, and in Cayman, it's roughly about 7.5 to 8%.
Thank you for that response, Kevin. I see another question coming in from a viewer. Considering the impressive performance over the past 6 years, is the company scared that it will not be able to maintain such sustainability over the next 6 years?
I wouldn't say scared at all. I think we have a strategy to continue to future-proof the business. It's one of the reasons why we look at what are some of the real estate trends that we're picking up. And what we're trying to do, as I said in the presentation, is to stay ahead of the game. So we look at what are the key areas that we need to be focusing on. We still think that there's going to continue to be strong growth in the industrial space, strong growth in terms of multifamily. So I'm not terribly concerned about the growth over the next few years. Another thing, too, is that we are leveraging some of the strategic partnerships that we have built over the last 14 years since we've been in existence. So there are other ways of growing organically that we are always going to be looking at.
All right, thank you for that, Kevin. Any other market outside of the traditional markets that you mentioned?
Sure. We've been looking at the Dominican Republic as one market, for example, and we've looked at deals in Guyana as well, but we've not been able to pull the trigger, for want of a better term, on any deal there. Mm-hmm. But more importantly, we still think that the U.S. is the largest and most important economy in the world and is likely to remain that way for the foreseeable future. I don't think we are deeply penetrated in the U.S. market, and we are looking at expanding into other parts of the U.S., and which is why we've gone into Georgia. We're looking at other states in the U.S. to make acquisitions in those.
Okay, understood. Another question coming in from a viewer is, given everything that's happening regarding interest rates, among other things, how confident are you that the real estate sector will continue to boom?
So that's a very good question, because interest rates also, is a factor for us when we're considering our acquisition strategy, how we're going to fund our acquisitions, because debt has been a part of it. And we're always ensuring that we set specific requirements in terms of our target rate of return for our specific investment, and we tie that to the cost of borrowing, and which is why in the presentation I showed you what our cost of borrowing is. There is a bit of a conundrum that a number of central banks are facing, is that you still have a fairly fragile global economy, so it's not like we have hot growth that is taking place where you can just jack up interest rates to very high levels. There is still some sort of balance that a number of central banks are now considering, what pace should they increase. And they've agreed they should increase, but they don't think that it should be at a fast pace. And I think that is going to continue. Once you do that, I think over time we'll get out of this high inflation, whatever you might call it,
environment,
cycle that we are in. and will continue to perform well in the portfolio. So once we tie our rate of return for the asset to our average borrowing cost, then we should be able to stay ahead of the game. The other thing to know too is that with interest rates rising, and I can give you that example, particularly for residential properties in the US, and why multifamily is an attractive opportunity for us, is that persons delay their purchase of a home. So, instead of buying the condo, most persons are going to delay their purchase of that condo and wait until, interest rates come back down. What that means is that they're going to rent. Mm-hmm. So when we acquire a multifamily property, and that's why we've been seeing such strong growth in rents in some of these markets. Again, try and pick up the trends and stay ahead of the game.
Thank you for that, Kevin. In terms of the other markets KPREIT operates in, what about the rise in interest rates and property valuation forecasts?
So let's start with Cayman, which is our largest presence outside of Jamaica. Cayman's rates still remain fairly low. And again, as I mentioned, they're also faced with the same situation of there is going to be a gradual increase in interest rates. That's one. The other thing, too, that is happening is, as I mentioned before, we tie the return of our investments to what our borrowing cost is. What does that mean for valuations? Remember, rents is a component of the inflation calculation. Our rents are tied to, whether it's interest rates or inflation. Most of our our leases are tied to some sort of inflation increments. So once you're increasing your rents at a pace that is in tandem with inflation or close enough to it, then you're going to continue to maintain the value in the properties.
Okay, understood.
The other thing I'd add to that too is that, remember, there are other components to the valuation of a property. I mean, demand is another thing. And one thing we've observed, particularly with Cayman, is that the demand for property in that market is very strong.
Interesting. What's driving that demand?
I think coming out of the pandemic, where most people realized, you could work from anywhere, Cayman actually devised what they call a global concierge program. So it basically offered persons the option of living and working from Cayman during the period of the pandemic. So there was a lot of demand for property in Cayman, primarily residential. But what we're seeing is that it's spilled over into the commercial sector because Cayman's population has grown significantly over the last 5 years because of the high influx of expats into that market. Mm-hmm. So there is a demand for services. So obviously there's the demand for residential properties, demand for commercial properties that will offer, whether it's for office or retail, etc. And because it's a small open economy that imports a lot, the need for industrial space is very strong. And that's why we're looking at the industrial space. We already have an industrial property there, and why we're acquiring a second one there.
Okay, I suspect that the changes, the legal changes in Cayman to accommodate the request of the West, because you have a lot of corporations that are in Cayman, but they don't necessarily operate in Cayman. Right. That would have contributed to a lot of the expats coming, right? So I guess that drives the demand for commercial properties. Well,
they've instituted economic substance rules. So what happens is that most companies would hire people. So once you have a physical presence or you have staff in the Cayman Islands, then you satisfy that requirement.
Yeah, I figured that was one of the contributing reasons. Another question coming from the public: is there a potential for a bubble? And I guess this is emerging based on what's happening with interest rates and commodity prices and safe haven assets.
Well, commercial properties haven't been moving at the pace that residential properties have been moving at. So I think the notion of a bubble has always been around residential properties, which is a space that we don't really play in, particularly as owning individual real estate units. We'll own a multifamily or a rental building, which the same principle doesn't apply for them. We don't anticipate that there is a bubble in the commercial real estate space.
Are there any plans to buy realtor firms locally or overseas as a way of diversifying income?
No.
Okay. I think this is all the time we have for a Q&A. I want to thank everybody for coming out for the questions. With the questions, we had it was a very good session. Very good questions. The presentation was comprehensive. I think we covered all, the important areas that you guys need to consider before you make an investment in this offer. And we're looking forward to your participation. And we hope that you will take this opportunity to gain access to real estate, because as I mentioned earlier, exposure to real estate in this environment is a proactive. Sorry about that, guys. We had an interruption during our presentation, and we would like to sincerely apologize for that. Before we go, so thank you so much, Kevin and Rez, for being with us. Thank you to our investors and our media partners for joining us today. As I said before, we had a great conversation this evening and have quite a bit to consider. If you're interested in VMwealth products or services, you can visit our website at www.vmwealth@myvmgroup.com or send an email to wealthinfo@myvmgroup.com. You may also contact us at 960-5000. As I said before, thank you. Looking forward to your participation and looking forward to continue delivering exceptional returns to your portfolio with this transaction.